Usually when you get a financial diagnosis, you expect, absolute precision. It's like an investor looks at an earnings report the exact same way a patient looks at an x-ray.
Right, you want that binary outcome.
Exactly. You break your arm, the x-ray shows the fracture, the doctor points to it, and that's it. It's broken. The reality is just undeniable.
Yeah, we totally gravitate toward that kind of comfort. Wall Street really wants a simple spreadsheet. They want the revenue line to go up, the profit line to go up, and for the conclusion to just be healthy.
But if you step into the world of legacy department stores right now, that diagnostic machine is just completely useless.
It really is.
We are looking at a landscape that just defies those clean categorizations. You get a situation where the headline numbers broadcast one reality, but then the underlying mechanics tell a completely different, almost contradictory story.
Right, because the current retail environment, it really requires looking way past the top line revenue. The surface level metrics almost never tell the actual story.
Which is exactly what we're going to do today. Welcome to this deep dive where we are pulling apart the Q1 2026 earnings call for Kohl's Corporation.
Yes, the ticker is KSS for those following along.
We are taking this dense, jargon-heavy piece of Wall Street tape and really extracting the narrative about the modern American consumer. Because, this is a legacy retailer founded way back in 1988 with these massive stores all over the suburbs.
And they sell everything. Clothes, shoes, home goods, makeup.
Right. And they are trying to pull off this massive operational pivot while the entire economic ground is just shifting right underneath them.
Which is what makes this specific earnings call so fascinating to study. The consumer they serve is facing some really intense financial headwinds right now.
Yeah, and that brings us to the core tension of this deep dive. So in this first quarter of 2026, Kohl's posted a net loss of $14 million.
Ouch.
Yeah, sales declined. They lost 13 cents a share. And yet, if you read the transcript, the CEO, Michael Bender, and the CFO, Jill Timm, they are framing this as a triumph.
They literally called it their best quarterly performance in over 4 years.
Right. So wait, I need you to explain this to me and to the listener. We don't have MBAs. They lost millions of dollars. Top line sales are shrinking. How on earth is management confidently signaling to institutional investors that the bleeding has stopped? It sounds like pure corporate spin.
I know. To anyone just glancing at the stock ticker, it sounds totally crazy. But you have to look at the plumbing of the business, the cash flow, the inventory architecture.
So walk us through the logic. How does losing money equal a massive win?
Well, it starts with a really important distinction in their sales data. So the headline is a net sales decline of 1.7%. But their comparable sales, what we call comps in the industry, only declined 1.1%.
Let's hold on that for a second.
Right.
Why is 60 basis point difference between net sales and comparable sales driving the whole tone of the call?
Because net sales captures every single dollar that comes in across the whole company. It's super volatile because it includes stores that just opened or, more importantly here, stores that closed.
Wow.
Yeah, the CFO made sure to point out that the 1.7% drop was artificially dragged down by store closures from last year. So comparable sales strip out all that noise.
Right. It only measures stores that have been open for at least 12 months. It's the only real apples-to-apples way to see if the core business is working.
Exactly. It isolates actual consumer demand. So the core business was only down 1.1%. And when you're in a turnaround, you have to look at the trajectory, not just the absolute number.
Because things used to be much worse.
Way worse. In previous quarters, they were taking much deeper drops in foot traffic. So approaching a flat comp basically means the structural decline has been arrested. It's a stabilization.
Okay, I hear the trajectory argument, but a decline is still a decline. The transcript even says fewer human beings are bringing items to the register. I still struggle to see how fewer checkouts equals the best performance in half a decade.
And that is exactly where you have to shift your focus from the income statement to the balance sheet. Revenue is just a vanity metric if generating it destroys your underlying health. The real story here is cash preservation. They ended Q1 with $429 million in cash. And crucially, 0 borrowings on their ABL.
Okay, let's unpack that. The ABL, asset-based lending.
This is something that just does not get enough attention when people talk about retail health.
It really doesn't.
For those navigating this stuff, an ABL is essentially a massive corporate credit card, but it's secured by the company's physical assets. Usually their inventory.
Exactly, the revolving line of credit. Because retail is so incredibly cash intensive, you have to buy millions of dollars of winter coats in July, long before anyone buys one in November.
Right.
So retailers use the ABL to bridge that gap. To make payroll, keep the lights on, the bank looks at your warehouse, slaps the liquidation value on the inventory, and lends against it.
But the danger is, if that inventory doesn't sell, you are completely trapped. You owe the bank, and your collateral is just depreciating on the rack every single day. Exactly. And if you look at where Kohl's was last year, at this exact same time, they only had $153 million in cash, and they had drawn down $545 million on that ABL facility.
Wow, so they were basically running on fumes and expensive short-term debt just to survive.
Yes, but this year, zero short-term debt on the ABL and $429 million in the bank. If you net those out, you are looking at an improvement of over $800 million in their net cash position compared to 12 months ago.
Okay, that is actually staggering. Over $800 million.
Right. It represents incredible financial discipline. They stopped using debt to buy bad inventory. Plus, they aggressively attacked their corporate bloat. They cut their SG&A selling, general, and administrative expenses by about $20 million.
Now, SG&A cuts always sound great on an earnings call. But how do you actually take $20 million out of overhead without totally ruining the store experience?
It takes a really surgical approach. You're looking at corporate salaries, marketing budgets, optimizing store labor hours based on predictive foot traffic.
Yeah.
They're basically trying to, squeeze every single ounce of waste out of the system. Because of that, their gross margin actually improved by 4 basis points. They are managing the cost of doing business incredibly tightly.
So you can absorb a slight revenue decline if your cash foundation is nearly $1 billion stronger and you're running a leaner operation.
Exactly.
But to understand why they're playing so defensively, we have to look at the macro picture. Management painted a pretty grim reality of what their core customer is dealing with right now.
They did. The core Kohl's consumer is really rooted in that low to middle income bracket. The CEO used this phrase. He said, these customers are sitting around their kitchen tables, forced to make incredibly choiceful decisions.
Kitchen table economics.
Yeah. The inflation of the last few years has just completely scrambled their spending hierarchy.
Because if you're agonizing over the cost of non-negotiables, food, utility bills, gas, housing, the money you have left for, a new sweater or home decor just evaporates.
Right. The consumer is heavily pressured. They aren't walking into a department store to just browse aimlessly anymore. They walk in with a strict budget. And if you don't offer immediate value, they just leave and go to Walmart or Target.
So how is Kohl's getting them to spend anything at all?
Well, that leads directly to their strategic pivot. The absolute margin savior of this whole operation is their massive expansion of proprietary brands.
Yes, private label. This is such a huge part of the turnaround. Kohl's proprietary brands were up 6% on a comparable sales basis. And the CEO even said that momentum hit 7%, specifically in Q1.
Which is huge when the rest of the store is flat or slightly down.
I would think of this as the Trader Joe's model, right? You don't go to Trader Joe's for Kellogg's cereal. You go for their specific private label stuff. You cut out the middleman, control the quality, drop the price for the consumer, and still keep a way bigger slice of the profit.
Exactly. Kohl's is basically applying that exact philosophy to a massive apparel footprint. It gives them what the industry calls an opening price point.
Which they admittedly drifted away from recently.
Yeah. Management actually admitted they messed up by chasing the prestige of higher-priced national brands over the last few years.
So what does lacking an opening price point actually look like for a shopper?
Well, imagine you need a basic men's t-shirt. You walk in, and all you see is a premium athletic brand for $35 and maybe a mid-tier brand for $25. If you're on a tight budget, you're alienated. You need a reliable shirt for, say, $12.99.
Right.
If the store doesn't have that $12.99 private label option, you don't just sigh and buy the $25 one, you walk out.
You leave.
Right. The retailer loses the whole transaction and they damage the customer's perception of their value.
Well, they are aggressively fixing that now. The transcript highlights some insane numbers here. In the juniors category, their proprietary brand called SO drove a massive 10% increase.
And 10% in juniors is a massive leading indicator. Juniors is notoriously the hardest department to stabilize because it's so trend sensitive, it moves incredibly fast.
Driven by TikTok and Instagram algorithms.
Right. So if your supply chain can anticipate a trend, make the clothes, and get them on the floor fast enough to pop a 10% gain, you're operating with serious agility.
And it's not just juniors. In women's and activewear, they called out LC, Lauren Conrad, Sonoma, and a brand called FLX. which is apparently doing so well in adult activewear that they're rolling FLX out to the kids department in every single store by June.
And that just shows the power of cross-pollinating a brand. If a mom buys FLX for herself and she likes the quality, the friction of buying it for her kids is gone. She already trusts the label.
Right, and they're pushing even younger too. They mentioned a new tween brand, Sea and Sky, that's beating expectations. And they're taking Jumping Beans, which is kind of their champion opening price brand, and expanding it into baby and infant stuff.
Which makes perfect sense because kids outgrow clothes so fast. That family at the kitchen table isn't going to buy premium baby clothes that'll be ruined in 2 days. They need durable value.
Totally.
So by leaning into this, Kohl's achieves two things. Psychologically, they show the stressed consumer that they get it. And economically, the profit margins on these private labels are just vastly superior to selling a national brand.
Oh, massively. When you sell a national brand, you're splitting the profit. The national brand needs their cut to pay for their own marketing and overhead.
Right.
But when Kohl's sells a Sonoma shirt, they own the whole process. They capture the entire margin.
The CFO even tied this back to rising shipping costs. They use the excess margin from a private label dress to offset the cost of shipping a cardboard box to someone's front porch.
It acts as a total shock absorber for the rest of the business. But, the crazy thing is, who is actually buying these private labels? It's not just new budget hunting customers. It's actually their most critical, previously disgruntled demographic.
The Kohl's card loyalist.
Yeah. This specific group is the absolute bedrock of their business model. In Q4 of last year, spending from the Kohl's card customer was down mid-single digits. But in Q1, it rebounded to completely flat. That is a 600 basis point improvement in just 90 days.
Stabilizing that cardholder is basically the prerequisite for stabilizing the entire company.
Now, I hear analysts obsess over retail credit card metrics a lot. Why does management care so much about someone using a store-branded card versus, just swiping a normal Visa? Isn't $1 of revenue just $1?
Well, $1 on a Visa generates product revenue minus a fee paid to Visa. But $1 on a proprietary store card generates product revenue, and it feeds a completely separate, super lucrative financial ecosystem.
The other revenue line item on the income statement.
Exactly. It's basically a specialized banking operation bolted onto an apparel business.
Right, because it captures interest payments, late fees, credit insurance, and retail cards usually have way higher APRs than standard bank cards. So if I finance a $500 wardrobe update and take a year to pay it, Kohl's gets the margin on the close and a huge yield on my debt.
Yep. Which leads to a really fascinating paradox in this quarter. The Kohl's card customer spent way more on merchandise, that 600 basis point improvement. But the other revenue line item was actually down 8% compared to last year.
Wait, so if their best customers are shopping more, how is the credit card revenue dropping?
The CFO explained this specifically. The 8% drop was because customers had lower accounts receivable balances heading into the year. Basically, they were carrying less debt on their Kohl's cards.
So fewer balances mean fewer late fees and lower interest income, which sounds bad on paper.
In the short term, yeah, it hurts total revenue, but strategically, it's a huge bullish indicator. The CFO emphasized that payment rates are up and loss rates, meaning defaults, are down.
The consumer is financially healthier. They aren't drowning in revolving debt, so they have what the industry calls open to buy. They actually have the credit available to make new purchases.
Exactly. You don't want your best customers defaulting. You want them using the card for recurring transactions. And the main reason they came back to use that credit is because Kohl's finally fixed their coupon strategy.
Oh man, the Kohl's coupon. It's culturally legendary, but the mechanics of it had just become so abrasive.
It really was. Retailers love using exclusions to protect margins on premium stuff. So they mail you a 30% off coupon, but when you get to the register, you find out it excludes Nike, Levi's, Under Armour. It creates massive friction.
You feel totally bait and switched. And on top of that, Kohl's had this crazy culture of stackable coupons. You'd have 15% off plus $10 in Kohl's cash plus a department discount. But they all had these arcane rules about what time of day you could use them.
It was exhausting for the consumer. So management executed a hard pivot. They significantly expanded the brands that are actually eligible for coupons.
Removing exclusions.
Right. And they moved away from the chaotic stacking model toward personalized offers driven by data.
So the loyalist, who is hardwired to hunt for deals, finally came back, and they're over-indexing in private label, petites, and fine jewelry.
Because the opening price points are there, the coupons actually work, and you don't need a calculator at checkout anymore.
Exactly. Now, if the loyalists are returning and buying private label and jewelry, let's look at how that maps onto the physical store layout. The category winners and losers really give us a heat map of consumer sentiment.
They do. So women's apparel achieved a flat comp, which the CEO openly admitted is historically a very volatile and difficult category for them. Hitting flat there is a major milestone.
Kids and accessories were also flat. But the real standout was home decor, right?
Yeah. Home rebounded by 400 basis points. It ran up into the low single digits.
Why the sudden jump in home?
It validates a return to disciplined merchandising. In the past, they'd buy massive quantities of one specific seasonal wreath. They sacrificed variety for depth. Now they've corrected that. They have a wider variety of seasonal decor, and they heavily promoted appliances from Shark and Ninja.
Okay, but the most aggressive tactical changes are happening right at the end of the shopping journey. They're deploying these psychological tricks to build basket size right before you pay.
The impulse queuing lines.
Yes. The CFO called them out specifically. These are those winding, serpentine paths you have to walk through while you wait for a cashier. Sales from those impulse lines surged by over 50% in the quarter.
50% is just staggering.
It's crazy.
But it shows the power of visual merchandising with low-friction pricing. They stock those lines with travel accessories, lip gloss, hair ties. The psychology is fascinating. A customer will agonize for 10 minutes over a $40 sweater, but they'll impulsively throw a $5 lip gloss in their cart without even thinking about it.
Zero financial anxiety. And they are taking that psychology deeper into the store, too. They introduced this concept called the deal bar for seasonal decor, strictly priced under $10.
That $10 threshold is huge for the stressed consumer. A $9.99 item doesn't break the grocery budget. It's an affordable indulgence. It gives you the dopamine hit of buying something without the guilt.
And right next to that, they rolled out toy towers across the entire fleet. Price points are exactly $4.99, $7.99, and $9.99. You know, squishy toys, introductory Lego sets. A stressed parent isn't buying a $100 playset on a whim, but an $8 squishy toy to keep their kid quiet in the cart. Immediate conversion.
It artificially manufactures a treasure hunt mentality, kind of like TJ Maxx. It trains you to visit more often because you expect to find a cheap weekly surprise.
Yeah, it's brilliant. But we really have to talk about the biggest shocker in the transcript. For years, their partnership with Sephora putting those massive beauty pavilions inside Kohl's has been the ultimate golden goose. But in Q1, Sephora actually underperformed the total company. It was down low single digits.
And when your primary growth engine misfires, Wall Street gets super anxious. But you really have to look at the nuance here. The beauty category isn't contracting. Preferences are just shifting really fast.
So how does it break down? What's selling and what isn't?
It's totally bifurcated. Fragrance is booming. Hair care is super resilient. The drag was entirely isolated to makeup and skincare, which really lagged behind their projections.
It's fascinating that fragrance is booming while makeup struggles. Is there an economic precedent for that?
Well, it really aligns with the lipstick index.
Right, from the early 2000s recession.
Exactly. The idea that in tough times, people stop buying designer bags and buy a premium lipstick instead as an affordable luxury. What we're seeing now is kind of an evolution of that. We might be watching the birth of a fragrance index.
The fragrance index. People are using premium scents as their daily affordable luxury instead of cosmetics.
Exactly. Management noted that new fragrance launches from Billie Eilish, Coach, and Kylie are doing incredibly well. They're heavily leaning into fragrance for Mother's Day and Father's Day.
But a beauty department can't survive on perfume alone. If skincare and makeup are dragging, how do they fix it?
By chasing modern trends surgically. To fix skincare, they're rapidly bringing in Korean skincare brands like Beauty of Koseon and Estura.
K-Beauty.
Yeah, it has massive viral momentum on TikTok. It's super effective and usually more affordable than legacy luxury skincare. And to fix the makeup deficit, they are rolling out MC Cosmetics.
Wow, MC is a foundational powerhouse. That adds instant credibility to the makeup aisles.
They tested it in March, and the response was so huge, they're accelerating the rollout to 850 stores by the fall. So top-line Sephora was down, but they've identified the exact subcategory failures and deployed the right brands to fix it.
Okay, so that's beauty. What other departments were dragging the comp down?
The main laggards were men's apparel and footwear.
Men seems to be a struggle across all department stores right now.
Well,
but what's the plan to save footwear? Because you can't really do private label sneakers easily. People are too loyal to Nike.
Exactly. Private label footwear is incredibly hard. So their strategy there is the exact opposite of apparel. They are banking on a massive back-to-school rebound by leaning heavily into huge national players. They're expanding styles from Nike and Skechers. For a department store, Back to school is literally make or break for footwear.
But having the right Nike shoe or K-beauty serum is totally useless if you don't actually have the customer's size in stock when they walk in. Which brings us to arguably the most critical operational shift on the call, Kohl's new inventory philosophy.
Yeah, inventory management sounds like boring back-office plumbing, but it literally dictates the entire financial health of a retailer. It controls cash flow, markdowns, customer satisfaction, everything.
Well, there's a specific stat from the CFO that sounds mathematically impossible. Total inventory decreased by about 8% compared to last year, but receipts, which is fresh inventory arriving at the stores, were planned UP by 1%.
Right. They engineered a system where there's less total product in the building, but a higher volume of new product constantly arriving.
It's like a struggling restaurant, tossing out their 10-page menu, deciding to only cook their top 5 dishes, but making absolutely sure the kitchen is packed with ingredients for those 5 dishes so they never sell out.
That is the perfect analogy for what Kohl's calls trip assurance. The CFO explained that in apparel, their choice counts, the variety of distinct styles, are planned down by high single digits.
So fewer styles on the rack.
Yes. But their depth, the sheer number of units in specific sizes and colors for those remaining styles, is planned UP by high single digits.
Okay, let's translate that. In the past, they might have 20 different styles of men's jeans, but they only carried one pair of size 34 in each style. Now, they only offer 12 styles, but they have 5 pairs of size 34 in every single wash.
That's the exact math. And it solves the friction of modern shopping. If a stressed customer spends money on gas to drive to the mall, they have a high intent to purchase. If they find a shirt, check the rack, and their size is missing. They leave empty-handed, you lose the sale, and you fracture the brand trust. They learn you're unreliable, and they go to Target next time.
So trip assurance is just the promise that if you show up, we guarantee we have your size.
Exactly. And because overall inventory is 8% lighter, they preserve cash. That liquidity lets them execute a chase model.
Explain the chase model. How does that work in real time?
Traditional buying means committing millions to winter coats in February, hoping they sell in November. If you guess wrong, your cash is trapped.
Right.
But when inventory is lean, buyers monitor point-of-sale data in real time. If a specific style of shorts starts flying off the shelves in April, they use that liquid cash to chase the trend. They place rapid orders to get more of what people actually want.
Instead of being handcuffed by a warehouse full of cargo pants nobody wants.
Exactly, and you can see it working. Their inventory turnover improved by 8% in the quarter. Merchandise moves from the loading dock to the register faster, which means fewer margin-crushing clearance sales later.
It's a masterclass in efficiency. But the physical store is only half the battle.
Right.
How does it integrate with their digital expansion? Because digital sales actually grew by 4% in the quarter.
They did, driven mostly by increased traffic. And the CEO spent a lot of time talking about new tech to capture that traffic, especially this new AI-powered gift finder using Google Gemini.
Okay, we have to be skeptical whenever AI gets mentioned on an earnings call right now.
Yeah.
Is this gift finder actually moving the needle, or are they just throwing out buzzwords to keep tech analysts happy?
You definitely have to separate the hype from the reality. The CEO said early data shows it helps with product discovery and increases time spent on the site. Like if you can type, find a Mother's Day gift under $50 for someone who loves gardening, and it instantly returns relevant private label items, that does remove friction.
Sure.
But an AI search bar isn't going to save a multi-billion-dollar retailer. The real hidden engine of their digital growth is the digital marketplace. Yes, which is a total shift from their traditional e-commerce model. Right. Usually, Kohl's buys wholesale inventory, warehouses it, lists it online, and takes 100% of the risk. If it doesn't sell, Kohl's eats the loss.
But the marketplace model makes them a landlord.
Exactly. They let vetted third-party sellers list products directly on Kohls.com. When you buy it, the third-party seller ships it. Kohl's just processes the transaction and takes a commission fee.
So they're basically doing what Amazon does, or what Walmart has been aggressively doing.
Yeah.
Zero inventory risk, high margin commission.
Yep. They plan to double their marketplace assortment this year, expanding into white space categories, things they could never sell in stores, like heavy furniture or specialized electronics.
It's risk-free margin expansion. And the CFO noted that if you include the gross merchandise value, the GMV from that marketplace, their total comparable sales would have been 50 basis points higher. It almost pushed the whole company to flat.
And it works synergistically with the physical inventory. By managing store inventory so tightly, they massively improve their BOPIS infrastructure.
Buy online, pick up in store.
Right. If you buy online and pick it up, Kohl's completely bypasses the cost of last-mile shipping. Plus, accurate store inventory means they can use their stores as micro-fulfillment centers.
Oh, that makes sense. If I'm in Chicago and I order a shirt, they can ship it from a store 10 miles away instead of a warehouse 3 states away. It cuts freight costs and speeds up delivery.
Exactly. Every single TWIC we've talked about, private labels, trip assurance, the digital marketplace, it all interconnects to wring maximum efficiency out of a really constrained environment.
It's a hyper-defensive strategy, and you really see that in their financial guidance for the rest of 2026 and how they plan to spend their cash. They reaffirmed their guidance, projecting comps between a 2% decrease and completely flat.
Operating margins stabilizing between 2.8 and 3.4%. EPS between $1 and $1.60.
And CapEx, capital expenditures, is set at $350 to $400 million. We know that's funding the impulse queues, expanding fine jewelry to 350 more stores, and rolling out Sephora in May. But beyond CapEx, how is a company sitting on $429 million in cash prioritizing its capital allocation?
Capital allocation is the ultimate test of management discipline. The CFO laid out a super strict pecking order. Number 1 is what you just said. Invest in the core business.
Got to feed the beast first. What's priority 2?
Priority 2 is the dividend. They declared a cash dividend of 12.5 cents per share. For legacy retailers, the dividend is a sacred covenant with shareholders. Cutting it is a massive red flag.
Right. So business first, dividend second. Where does the rest go?
Priority 3 is opportunistic debt repurchases. And the mechanics here are fascinating. In Q1, they used $41 million in cash to buy back $50 million worth of their own debt on the open market.
Wait, walk us through the math on that. How do you wipe out $50 million in debt by only writing a check for $41 million?
Because corporate bonds trade on the open market just like stocks. A company issues a bond at par value, say $100, promising to pay it back later. But if interest rates rise or the market gets pessimistic about the company, the bond's trading price drops. It might trade at $80.
Even though they still legally owe the full $100 at maturity.
Exactly. So Kohl's saw their own debt trading at a discount, stepped into the market, spent $41 million, and retired bonds with a face value of $50 million. They permanently captured a $9 million discount.
That is wild. It's like finding out your mortgage is trading at a discount and paying off 50 grand of principal for only 41 grand.
Yeah, it immediately deleverages the balance sheet and eliminates future interest payments. It's brilliant.
Okay, so what's the fourth and final priority for cash?
Share buybacks. But with a massive caveat, they have officially suspended all share repurchases until the balance sheet completely normalizes. The CFO said they want to run the business with about $700 million in cash. Until they consistently hit that threshold, the buyback program is frozen.
Which just underscores how defensive they are being. They refuse to artificially inflate the stock price until they have a total fortress balance sheet. But if you read closely, there is this massive unexpected wild card that could get them to that $700 million way faster. It was buried right at the end of the CFO's remarks.
The tariff refund.
Yes. In a total throwaway comment, she noted that Kohl's is eligible for a $190 million refund on Phase 1 COPE tariffs. They already submitted claims to claw back $140 million of it.
That is a staggering detail to drop at the end of a call. Companies that import textiles pay massive customs duties. Sometimes, through legal challenges, they can qualify for retroactive refunds. But the crazy part is the CFO confirmed this $190 million is entirely excluded from their 2026 guidance.
It's completely off book. I mean, they are projecting to generate maybe $500 to $600 million in free cash flow this year. If the government suddenly clears a $190 million check, what does that do to the turnaround timeline?
It alters reality overnight. That kind of cash infusion instantly bridges the gap to their $700 million threshold. Once they cross that, they could aggressively pay down more debt, hyperfund private labels, or immediately turn the share buybacks back on. It's a massive variable just hovering out there.
So when we synthesize everything, the private labels, the trip assurance, the debt repurchases, what is the ultimate takeaway on their playbook for 2026?
The playbook is pure surgical defense. They're defending margins with private labels. They're shrinking overall inventory, but ensuring they always have the right sizes. They're fixing their coupons to keep their best customers. And they're fortifying the balance sheet to wait out the macro storm while less disciplined competitors fail.
It really is a masterclass in controlling what you can control when the broader economy is just totally out of your hands. We have covered so much ground today. The paradox of shrinking sales, masking better cash flow, the private label economics, the hidden banking of the Kohl's card, the psychology of the deal bar.
It's a phenomenal case study in resilience, but it also forces you to step back and look at the whole sector.
Yeah, and we want to leave you, the listener, with a final thought to consider the next time you're analyzing a retail stock or just, walking through the mall.
Think about the historical definition of a department store. It was supposed to be a massive hub for premium national brands.
Right.
But if a legacy retailer has to survive by shrinking national brands, aggressively making their own private labels, and competing almost purely on opening price points, are we watching the death of the traditional department store?
That's a great question.
Right. If Kohl's pulls this off, they won't really be a department store anymore. They'll just be a massive value brand apparel retailer. What does that mean for the American mall? And where do the big national brands go to sell their stuff if department stores stop buying?
It fundamentally changes the entire ecosystem. The truth of a company is rarely in the headline numbers. It's buried deep in the operational mechanics. Thank you so much for joining us on this deep dive. Keep digging into those balance sheets, and we'll see you next time.